Hi, I'm Mike Ward. I want to talk to you about efficient markets. Now, efficient markets essentially is a hypothesis in finance and economics that you may have heard of, especially if you come from those disciplines, and made famous by one of these two guys. Now, I don't know if you recognize these two individuals in the newspaper here. This was in 2013 when the two of them and a third guy actually were awarded or shared the Nobel Prize in Economics. Now, the man on the left is Eugene Fama. He's famous for the efficient market hypothesis. He's also famous for his Fama-French three-factor model. And you may have heard of those things if you have a finance background. But what is really interesting is the guy on the right is Bob Shiller. And he is not a believer in efficient markets. So in its strong form, the efficient market hypothesis says that investors are so diligent and careful and hardworking and smart that they are able to ensure that share prices are correct all the time. And if you read about something that happened overnight to a company, good or bad news, and you try to buy it because you read it, it's too late. It's already, the seller or the buyer also read that same information and it's included, it's priced in, we would say. Now, some jokers have said that, and in fact, they've actually done this. They've had monkeys or chimpanzees throwing darts into the newspaper to pick portfolios of shares and compared the performance of those portfolios to professional analysts. And well, sometimes the chimpanzees and monkeys win. Sometimes they don't. But Rob Shiller says, this can't possibly be the case. And I find it interesting that the Nobel Committee, who clearly don't know much about finance, can share the prize with two diametrically opposed viewpoints. So let's talk a bit more about this issue. We know that markets can't be efficient because it's impossible to have all the disasters that we read about taking place so frequently all the time. So this is Steinhoff. You may remember them. In 2017, they wrote off all of a sudden 250 billion rands worth of market capital when some issues were discovered. And this was the darling of many investors, South African company based in Stellenbosch, and for years had been showing spectacular growth. That's always a sign of a bad problem. And the other sign of a problem is a charismatic leadership. These two things seem to go together. Marcus Juster, who was the CEO and had been touting high levels of growth, very personally invested in this company, and of course, there were all kinds of issues came out. That company's worth a few cents. It hasn't gone under, it's still trading, but it just worth almost nothing. Now, you can see similar things. Here's Toshiba. You may remember them in 2015. This was one of the biggest scandals in Japanese history, maybe the biggest. And the CEO, Mr. Tanaka, had to resign. They had inflated profits by $1.2 billion over several years. How does this happen? How come if markets are so efficient, they can't pick up on this kind of stuff? So we see so much of this. This is one of my favorites. This has been playing out and was just a couple of weeks ago that it came to an end, actually. Autonomy, the crime of a century. So Autonomy, if you are not familiar with it, was a small UK-based company which was involved in software and accounting stuff, and they sold hardware and computer stuff and so on, and was run by a guy called Mike Lynch. And what happened was Hewlett-Packard, who were trying to change their kind of trajectory, their business model, liked the look of this, and so they wanted to buy it, but before they did, because they were paying quite a big price for it, they sent in a couple of auditors to go and check that the numbers were correct. And so they sent in Deloitte and KPMG, who were not the current auditors of the company, And they said there are no irregularities here, even though there had been a lot of smoke about this company before this. And so they bought it. They paid $11 billion for it in July 2011. Well, 1 month later, the CEO, Leo Apotheker, was fired for this acquisition. They brought in Meg Whitman, who you may remember from eBay, and she hired another accounting firm, PricewaterhouseCoopers, PwC now, and they went and investigated. Of course, they found all kinds of problems. They booked low margin sales as hardware, as software sales, and expense the sale of hardware as marketing costs and all kinds of stuff, trying to make the growth rate of this company look fabulous. So they wrote down $9 billion, paid 11, and a couple of months later, they wrote off $9 billion, saying they'd overpaid. And then, of course, they sued the CEO of the company and so on. And you can see there's a whole trajectory over here of what happened. What's interesting, of course, is if you look at what they paid for it, they paid 23 times EBITDA. I mean, that's a crazy price to, I mean, I would expect, 5 times EBITDA. 23 times is very pricey. That's pricing in extraordinary levels of growth. And well, then, of course, it just all unraveled, and then they sued each other. And but this thing came to a head recently. And this, I'm just reading from you here. These findings are the most serious ever made against an audit firm in a tribunal report, said Rebecca Sabin-Clark, Queen's Counsellor, barrister for the Financial Reporting Council, the UK accounting watchdog, during the hearings. So Deloitte were fined £15 million for this. They appealed, but recently I think that was upheld. The CEO of this company, Mr. Hussain, this is of the company that was bought, AUTONOMY, has been sentenced. He's doing prison time in the US, I think, for 5 years. So, I mean, it's not that there aren't penalties, but how does this happen if markets are so efficient? Well, we see so much of it that it's hard to believe that markets are that efficient. So here's Caterpillar. They did a similar deal. They bought a Chinese company, but before they bought it, they went and they hired 2 companies, I think it was, who went and did detailed due diligence. That's not just an audit. They went to check stuff was there, but then they found it wasn't. In fact, there was deliberate, multi-year, coordinated accounting misconduct in this company. Came out shortly after they bought it. And but we read about this all the time. Here's some more recent stuff. Luckin Coffee slides after finding $300 million of sham sales. They just recorded sales that didn't exist. But what about Wirecard? I mean, wow, this has been quite a story that's just been playing out in the last couple of months. One of Germany's most prominent securities lawyers files an investor lawsuit against Wirecard, accusing the payment group of false, omitted, and incomplete disclosure. So lots of people were onto this. But here's Jim Chanos. He is a hedge fund guy. He shorted this company, and for many years, or quite a while, he just got burned. His shorts just got burnt. But in the end, he made $100 million out of this. Short seller Chanos bags $100 million after Wirecard numbers didn't make sense. So he sees himself as a self-professed forensic financial statement junkie. And so he took a bet on this company, and eventually he came right. But it's painful being a short seller when things don't go your way. And you would have seen some of this. Another charismatic leader who's been accused of manipulating numbers frequently actually is Elon Musk. So far, he's held out, and Tesla seems to keep on getting the numbers. So, but when it came to Wirecard, we start seeing all kinds of issues here. David Ironhorn, he's another activist investor. He says Wirecard was fraud waiting in plain sight. And how did they miss this? And EY's draft audit on Wirecard rejected whistleblower and KPMG concerns. There were concerns raised about this company by whistleblowers, insiders, and other audit companies. But they said everything's fine. And so, and we're not talking about any, strange accounting even here. This was about cash. There was a whole, $1 billion of cash, which was on the balance sheet, didn't exist, and they didn't look. I mean, how does this happen? And so EY battles on 3 fronts to defend its name. This is all very recent stuff. They've had problems with NMC Health, a Dubai gold business, and Wirecard. And so how does this all work? Let's try and get a sense of what we're up against. You see, people, you and I, young people, people working, and pensioners are in the investors who have most of the money that's at risk here. And they want to invest in equities. And so they'd like to put their money into companies. But they're not experts in doing this. And it's no good asking the managers of companies whether their company is a good investment. Of course, we know what they're going to say. So investors put their money in institutions, pension funds. And pension funds are supposed to be good at this. They then go and check out the companies, and they make decisions, and they invest on behalf of the pensioners their money in these companies. So that's fine. But at the end of the day, well, before the end of the day, what do these investors want? Well, until they actually go on pension, they just want to be sure that their money is safe and that it's earning, it's growing. That's all they really want. They don't want to even see the cash. When they go on pension, of course, then they'd like to start seeing some of the results of all of this. So who are the gatekeepers? Who's checking that the system is working? Because you can't really ask the institutions. They're going to tell you, gee, we're good. Don't worry about us. We're looking after your money. And no good asking the managers, the companies. They're going to say everything's fine. So we need someone to play a role here, making sure that everything is fine. And if you were to ask what sorts of qualities should those gatekeepers have, I think we could agree that they should be independent, not connected to the company or the institution, that they should be smart experts, they should understand what's going on, and maybe it would be nice if they had some skin in the game. So I'm listing those things over there. It would be nice that, they also, if things are wrong, they've got something to lose as well. But who plays this role? Well, as you and I know, it's really the auditors. And if you ask yourself, are the auditors independent? Well, no, because there's huge conflicts of interest here. They're paid by the companies. Are they experts? Well, they hold out that they're experts, but this stuff is complicated. And do they have skin in the game? Do they lose when everyone else loses? Well, sometimes there's penalties to be paid, as we saw just now, but not much. So the system doesn't really work that well. And so you can see they've been trying for years to get auditors to, try harder. And in 2013, auditors will have to provide more detailed information when signing off companies' financial statements under a controversial proposal and so on to prevent more accounting scandals. I mean, this is not new. It's been going on for years and years. And so, this stuff is also quite complicated. And for years, accountants haven't really understood things in economic terms. That would be my opinion. So take leases, for example. A lease has enabled companies to have what we call off-balance sheet financing and assets. So instead of owning the aeroplane, KLM can just lease the aeroplane from some other company. It's on their books, not on KLM's books, but KLM are using, actually they're running and operating the airplane, and it should really be on theirs, and there should be a big loan showing against that aircraft. I'm picking on KLM, I'm not even sure. But you can see here, Sir David Tweedy was chairman of International Accounting Standards Board, and he joked his lifelong ambition was to fly in an aircraft that actually existed on an airline's balance sheet. Of course, it should be on balance sheets, but it's only now, recently, that we're starting to see IFRS 16, I think it is, pushing the accountants to actually show these loans, which are the lease, and the assets on the actual operating company's balance sheet. So, and there are many of these things. It's complicated business, this stuff. So we're starting to see lots of criticism with the big four, and there's not a lot of competition. There are only four of these guys who are, doing all the auditing, or most of it. And you can see the FT constantly raising issues here. One of the issues is that companies don't like to change auditors that often. And you can see here's an extreme case. This is the S&P 500, and here is P&G, Procter & Gamble, who Deloitte have been auditing since 1890. I didn't even know P&G was that old, but I mean, wow, that's 130 years, the same auditors. That's kind of cozy. But on the, one can argue that switching auditors every 3 or 4 years is really difficult, because then, the new auditors have got to learn the old tricks, and it's going to make it worse. So I don't think there's a good answer to this, but it's a problem. Should we feel sorry for the auditors, as some people are suggesting? I mean, mostly they get it right. I mean, they look at thousands of companies and only 1 or 2 are really a problem. So, should we be complaining? Not only that, they're under huge time pressure. Companies cannot, when they come to their financial year end, they've got, if they're listed, a few months, 2 or 3 months to actually publish their, audited financial statements. Otherwise, they suspended from trading. So, when you're dealing with a big multinational with complicated set of financial statements and some very complex instruments there, wow, that's pretty hard to do. They're not paid a lot. And so depending on where you are, fees earned by auditors on average in the EU are 0.13% of turnover. In the US, it's 3 times that. But there's still problems in the US. In Germany, it's only 0.09%. So, maybe there was the problem with Wirecard. I don't know. And this stuff is complex. Financial instruments these days are not easy to unravel and very confusing. If you want to hide stuff, and there are huge incentives to cheat here, boy, you can do that. And the auditors have no idea. They don't know what to look for. It's not even as if there's a body there or a smoking gun. I mean, they have got to dig and just hope that there isn't anything. So maybe we should pity them. But on the other hand, there are some issues. They are paid by the client. That's clearly a conflict of interest. And, even if the audit fees aren't that high, we know that the audit arm of these large accounting companies fees their consulting. And that's where the fees are really made. And although there's been lots of efforts in various countries and around the world to separate the consulting and auditing arms of these companies, they keep reappearing in some form. And the penalties, although there are penalties, are relatively small. So the system just really isn't working. So here you can see, this is Jan Bovens, professor of accounting, Amsterdam Business School, University of Amsterdam, is saying, gee, don't underplay the auditor's role. They do a lot of stuff. He's talking about Wirecard here, and he says, suppose 1 in 2,000 audits goes wrong. Is that bad? Well, it is bad if it's your investment and you're the one who lost, a chunk of your pension. So it's an issue. This is Brooke Masters, and she's been on at this for a while. She's the company's editor of the Financial Times, and she says auditors keep falling into the same trap again. And they're never going to stop biting, or they're never going to bite the hand that feeds them. And that's part of the issue, these conflicts of interest. And she talks about this. She said, I'm tired of reading these stories. Wildcard and Parmalat, and she's got a whole bunch of Carillion and so on. We've heard of many of these, and these things, it just keeps going on. She says, I'm tired of reading these stories. It's time to rethink the whole model. We already know that when bank regulators became captured, the public pays the price. Pensioners pay the price. And so we need to do more. But what are we going to do? That's really the difficult part. I don't have answers to that, but I wanted to raise some of the issues, and I thought I'd end by showing you just this issue here. One way to spot companies that are kind of causing some problems is to look at what we call accruals. We would expect that operating profit ought to match operating cash flow. And if you take operating profit and subtract operating cash flow, and you find that there is a positive accrual, then it's really pointing to problems. And what we can see here is that shareholders are looking at this, because this is a style analysis that we ran, Chris Muller, my colleague, and I, a few years ago, looking at South African companies. And you can see that if you had bought a portfolio and you keep rebalancing this portfolio, and you picked the companies which have got positive accruals, in other words, the cash flow isn't showing what the profits show, they are going to be undervalued by investors. And it's better to go for negative accruals, or as close as you can get to that, let's put it that way. At least the money is really there. So you have to be careful as an investor when you look at these companies. The system is doing its best, but it's not winning. I hope you found that interesting.